Guys, today we need to talk about NIO stock and what's happening behind the scenes because there's a lot more going on than just price movement. Over the last few days, something very unexpected has gone viral inside China's EV community, and it's actually putting NIO in a much more positive light than most global investors realize. The whole conversation started when NIO confirmed that its Firefly models will not be using the CATL battery swap standard. And the reason shocked people: CATL's swap system uses air cooled batteries, while NIO's entire battery platform is fully liquid cooled. Now, that's not new information by itself, but what people didn't know is just how advanced NIO's liquid cooling system actually is. What surprised everyone is that NIO's cooling liquid isn't sealed inside the battery pack the way most competitors do it. It actually flows through a regulated system that both the car and the swap station can manage. The vehicle can pull cooling liquid out of the battery or push more into it depending on temperature, and the swap station itself can add or remove fluid during service. Most people didn't even know this was possible. The Chinese community was genuinely shocked because this system massively reduces battery pressure buildup during heat expansion and contraction, which is exactly the issue that has caused multiple incidents with other brands. For example, Li Auto had a vehicle fire recently, specifically because their cooling liquid is static and trapped inside the pack. When temperature spikes, pressure builds with nowhere to escape, and the result was thermal runaway in under 10 seconds. When people compared that to NIO's approach, the difference in safety was huge. NIO's design avoids that scenario because the cooling fluid can actually move. It's actively regulated, not sealed. This went viral because safety is a serious topic in China, and the reaction was kind of mixed. People were impressed and relieved that NIO had engineered such a fail safe system, but they were also frustrated. Many Chinese owners said, "Why didn't NIO tell anyone this before? Why was this hidden?" In China, there's an expression that translates to hiding the meat under the rice, meaning the product is incredibly good, but the company doesn't market the best parts of it. And that's exactly what happened here. NIO built a premium, safe, highly engineered system, but never highlighted it the way competitors hype their features. That lack of communication is now being discussed everywhere online. People are basically saying we bought these cars without even knowing half of what they're capable of, and honestly, it reflects both NIO's strength and one of its biggest weaknesses. The strength is obvious, the engineering is legitimately top tier. The weakness is that the company doesn't communicate its advantages clearly, especially at a time when the EV market is extremely competitive. Now, the second part of the conversation is the split in the battery swap ecosystem in China. There was an assumption for years that eventually a universal standard would appear where all brands could use the same swap stations. But after the Firefly announcement, it's becoming clear that this will never happen. And the reason is simple: liquid cooled packs and air cooled packs can't share the same infrastructure. They're designed differently, cooled differently, and maintained differently. So NIO is building the premium high end swap network for liquid cooled packs, while CATL is targeting the low cost mass market segment with ultra fast air cooled swaps. This was reinforced when JD.com, which is basically the Amazon of China, launched its own EV built by GAC. The car is cheap, compatible with C8ATL swap, and does a full battery swap in 99 seconds. They also offer a battery subscription for around 499 yuan per month, making total ownership cheaper than even NIO's Firefly models. This shows the ecosystem is diverging into two segments: liquid cooled premium swaps with NIO and ultra cheap mass market swaps with CATL. And because the technologies are fundamentally different, the networks will coexist rather than merge. Now, let's talk about the stock price. NIO shares have pulled back recently, but part of this is simply broader market exhaustion after a strong rally. Profit taking is happening across multiple sectors. Another factor is investor uncertainty heading into earnings. The company already said that Q3 expenses would be higher because of two major product events, including the ES8 launch and the ONVO event. When companies ramp up spending on launches, the impact often shows up immediately in that quarter's earnings. Because of this, some investors might be stepping aside until results are out. And honestly, I don't think Q3 earnings will look great. NIO already hinted that most of the heavy spending happened in that quarter to avoid carrying the same costs into Q4. So the market may be bracing for a weaker report. But here's where it gets interesting. The market doesn't seem to care about the record deliveries. NIO has been posting massive weekly delivery numbers, and the stock price isn't reacting the way you'd expect. That usually means one thing: investors believe those delivery numbers were already priced in. The success of the ONVO L90, the performance of the ES8, and the overall volume momentum might all be baked into expectation already. However, I don't think Q4 profitability is priced in at all, mainly because most people don't believe it will happen. Even I'm skeptical, but I'm also optimistic because NIO has aggressively cut costs throughout Q3. Visibility inside China shows that NIO has been streamlining operations and reducing overhead while increasing volume. So, profitability in Q4 is possible, not guaranteed, but possible. And if that happens, it could be a major surprise to the market because sentiment is still very cautious. Q4 earnings don't come out until March, so there's still time before the market prices in any of that. If NIO does achieve profitability, that completely changes the entire long term risk profile. It removes bankruptcy fears, removes cash burn concerns, and signals the start of a new phase for the company. They already have the growth part figured out. The deliveries prove that they just need consistent margin improvement to flip the story from scaling to scaling profitably. Right now, the stock price looks weak, and it's frustrating to watch, but this is normal. Nothing rallies in a straight line, especially not in the EV sector. Temporary pullbacks happen even during bull phases, and while people in the comments are treating this as a buy the dip opportunity, I always remind everyone that this isn't financial advice. The right approach is to understand what the stock is doing, what the company is doing, and what the upcoming catalysts are. For NIO, the big catalysts are clear: the earnings results, the profitability path, continued delivery strength, and how the company positions its engineering advantages. The battery cooling system going viral in China is a reminder that NIO's problem isn't engineering, it's communication. And if the market finally understands the real value baked into NIO's vehicles, sentiment could shift quickly. And there's another angle to this whole discussion that isn't being talked about enough, especially outside China. For years, global investors and analysts have evaluated NIO primarily on price action, quarterly earnings, or short-term cash burn. But what's happening right now inside China is a shift in public perception. When regular consumers suddenly discover a safety advantage this big, especially one that has been quietly built into the cars for years, it changes brand trust. And brand trust in the EV industry is incredibly valuable because once a consumer believes one brand is safer than another, switching becomes very unlikely. This is how long term loyalty begins, not through marketing slogans but through real engineering. And this is important because the Chinese EV market is brutally competitive. Brands fight on pricing, features, and promotions every month. One misstep can cause a car model to fall out of favor. But safety is one of those areas where if you're strong, you remain strong for years. Tesla built a decade of global reputation simply because of safety ratings. BYD is gaining traction because of its blade battery safety now. NIO's liquid cooled regulated system is entering that same conversation. And when an entire community suddenly realizes this car is actually safer than we thought, you gain organic marketing that money cannot buy. People share videos, post comments, make comparisons, and suddenly the narrative changes. This is why the reaction inside China was so emotional, not because the feature was new, but because they felt it should have always been communicated clearly. And this brings us to NIO's marketing challenge. NIO has always been a product first company. They engineer first, market later. They're humble to a fault. And while that's admirable, it also hurts them in a consumer environment where louder brands often win attention, even when their products are inferior. If NIO wants to unlock its full potential, it needs a communication strategy that reflects the engineering effort happening behind the scenes. People need to understand what they're buying because the average consumer isn't reading white papers or studying battery thermodynamics. They only react to what's being communicated. And in the EV world, perception drives price and price drives valuation. If NIO starts communicating the value of its technology more aggressively, it could drastically change sentiment not only in China but globally. Now, let's talk about the macro environment because this also influences the stock. The EV slowdown narrative has been dominating global markets. Analysts keep saying EV sales are plateauing, legacy automakers are delaying EV programs, and geopolitical risks are rising. So, even strong companies sometimes suffer in sentiment during uncertain periods. That's partly why NIO stock hasn't reacted to good delivery numbers. Investors are scared of the entire sector, not just NIO. But here's the nuance: EV companies with strong technology, brand loyalty, and a unique ecosystem tend to survive these cycles. A company like NIO with battery swapping, a lifestyle ecosystem, premium branding, multi brand strategy, and high safety engineering is not the same as a company that launches a cheap EV with no ecosystem. These are two completely different paths. And in down cycles, differentiation matters even more than growth. This is why Q4 profitability, if achieved, would be a major psychological turning point. It wouldn't just be a financial milestone, it would be a narrative milestone. It would mark the moment where NIO transitions from high growth, high burn EV maker to scaling EV ecosystem with operational discipline. And markets reward discipline, investors reward proof. Profitability has the ability to flip sentiment, re rate valuation multiples, and attract long term money rather than speculative flows. But until that happens, investors will remain cautious. That's why you're seeing unusual price behavior, strong deliveries, good customer buzz, strong brand developments, yet the stock trades sideways or even down. This disconnect happens when the market prioritizes cash flow over growth, and that's exactly where we are right now. Another factor to consider is how NIO's multi brand strategy affects investor psychology. ONVO is doing extremely well. Firefly is capturing the entry market, and the NIO brand itself is maintaining premium momentum. But Wall Street historically struggles to value multi brand structures. Companies like BYD also faced this problem early on. Investors prefer simple stories: one brand, one market, one type of customer. But in China's EV landscape, complexity is a requirement. You must hit multiple price points, multiple features, multiple consumer types. A multi brand strategy is essential to compete with giants like BYD, but it takes time before investors appreciate the compounding effect. And speaking of compounding, something investors often underestimate is NIO's growing fleet of active cars on the road. More vehicles equal more service demand, more swap usage, more subscriptions, more ecosystem revenue. It's not just about upfront vehicle ASP anymore. It's about lifetime value per user, battery as a service, subscription upgrades, autonomous packages, lifestyle memberships. These things scale non-linearly when you have hundreds of thousands of vehicles active. This is how Tesla built recurring revenue. NIO is building its version of that, but through the lens of its own ecosystem. The stock may not reflect this yet, but the groundwork is being laid. And once the company achieves margin stability and consistent profitability, the market will finally be forced to value the ecosystem rather than just the vehicle business. For now, investors should understand that the story is bigger than the headline numbers. The safety engineering discovery, the multi brand strength, the expanding ecosystem, the potential for profitability, all these things matter. The question is timing and execution. And that's what makes this moment for NIO so important. Stay disciplined, stay focused, and take care of your health. Let's see how this NIO story unfolds.